Alibaba is essentially trying to rewrite how corporate IT budgets work just to justify a $100 billion cloud target. It is March 19th, 2026, and we are digging into Baba's third quarter. And, quick reminder before we tear into the numbers, this is just our personal opinion, definitely not financial advice. Do not make trades based on us geeking out. Anyway, the top line actually looked genuinely strong here. Revenue hit $40.7 billion, up 15% sequentially. But then EPS just slid 32% to 85 cents. It is a mixed bag.
Well, it is. Actually, it is a very expensive pivot. You look at operating income, and sure, it rebounded, up 98% from last quarter to $1.52 billion. But year over year, down 74%. They are basically setting cash on fire just to defend their turf.
And the market definitely felt that whiplash. I mean, the stock dumped hard pre-market right around the earnings call, dropped down near 122.
Right, but then it completely reversed at the open. It actually finished the regular session up 1.5%, trading in a really tight range around 125. I think, honestly, people looked past the earnings drop and saw the cash flow. Free cash flow swung back to positive $1.62 billion after that massive outflow last quarter. The bleeding stopped mostly.
Mostly, but you mentioned the cash fire, and, oh man, it looks like a huge chunk of that is coming from quick commerce. They're officially burying the Ele.me brand and absorbing it entirely into Taobao.
Yeah, and the retention costs for that restructuring are, well, they're brutal. They took a 2.7 billion RMB hit in their unallocated segment, just paying staff not to leave.
Right, paying them just to stay through the transition.
Exactly, because they're chasing this, frankly, insane target of 1 trillion RMB in gross merchandise value by 2028. It's growth through sheer force of subsidies.
Right, but then you look at their AI side, and it's a completely different story. Cloud intelligence revenue grew 9% sequentially, and they shared this wild anecdote from the Lunar New Year. Over 140 million users were using their AI agent to book travel and order food, without even clicking through menus. It was entirely automated.
The consumer adoption is there, sure, but to me, the real story is on the hardware side. Management actually admitted on the call that their in-house T-head chips still lag behind foreign counterparts. You almost never hear tech executives admit that kind of vulnerability out loud.
Okay, so what's their workaround? Because they're still under massive export restrictions.
Their solution is to tightly co-design the physical chips directly with their Qwen AI models, stripping out the universal waste and just forcing enough custom efficiency to survive the export bans.
So they are literally engineering their way out of a geopolitical chokehold.
Right.
All right, let's get into the details on that.
Right. So usually when a tech giant talks about co-designing hardware, it is just marketing fluff. But for Alibaba, it is a survival mechanism. They essentially admitted on the call that they are backed into a corner. The translator actually quoted them saying, "Over the next 3 to 5 years, global AI computing power will be in extremely short supply, especially in the Chinese market."
So they're basically accepting the hardware penalty. They know they cannot buy NVIDIA's best chips, so they build a software straitjacket around their own homegrown chips just to force them to run faster.
Straitjacket is a great way to put it, yeah. The T-head chips, they only have to be good at one very specific thing, running the Qwen models. They strip out all the universal, the general purpose compute architecture and just hardwire the AI directly into the silicon. It's basically taking a massive computational disadvantage and solving it with sheer software brute force.
Which is a fascinating engineering pivot, but how does that actually pay off? You do all that custom hardware work, you spend billions, but how do you monetize it to the point of hitting Eddie Wu's, what was it, $100 billion cloud revenue target?
This is the really elegant part, or maybe terrifying, depending on how you look at corporate accounting. To hit that $100 billion over 5 years, they completely reorganized their internal structure. They created this new master division called the Alibaba Token Hub.
token hub. I mean, that sounds like a defunct crypto exchange from 2021.
I know. I thought the exact same thing when I read it. But no, it is entirely about AI inference tokens. They are unifying their whole model as a service strategy. And the core of this, the actual genius of it, is they are trying to reprogram corporate psychology. Up until now, AI has been an IT expense, and IT budgets are fixed. A CIO has a hard ceiling on what they can spend.
Right, and if you hit the ceiling, you just stop buying software for the rest of the year.
Exactly. But management noted a massive shift. Let me find the exact quote here. Right, they said, many enterprises now, when consuming tokens, don't treat token consumption as part of their IT budget any longer. Instead, they see tokens as part of their overall operational or R&D costs.
Oh, wow. Okay, wait. So they are moving AI out of the software budget and turning it into a cost of goods sold.
That is exactly it. They are turning it into a raw industrial material.
That is honestly brilliant framing, because cost of goods sold scales natively with revenue. If AI is just another raw material, there is no budget ceiling. You just buy as much computing power as you need to produce the end product.
It is like selling electricity to a factory instead of selling them a software subscription. The factory does not cap its electricity bill if it is actively producing more goods. And with their new Wukong platform, the enterprise agent tool, they are directly wiring AI into these company workflows. So the more tasks a company executes, the more tokens Alibaba inherently sells.
I mean, that entirely changes the cloud narrative. It goes from this rigid SaaS contract that you renegotiate every year to a metered raw utility.
It does, though, and I will be the skeptic here for a second, it requires the enterprise client to completely trust Alibaba's public API structure. Big Chinese banks, massive state-owned enterprises, they usually demand private on-premise cloud deployments just for data safety.
Sure, nobody wants their proprietary financial data inadvertently training someone else's foundation model.
Exactly. And those custom on-premise setups, they are highly capital intensive. They are way less profitable for Alibaba than just selling API tokens from the public cloud. So management is projecting this beautiful vision of infinitely scaling high-margin token revenue. But reality might force them to keep building very expensive, very private sandboxes for their biggest clients.
It feels like they're walking this incredible tightrope. On one side, they have this massive, unconstrained AI ambition unlocking endless corporate budgets. And on the other, they are still burning absolute piles of cash just to keep people buying groceries on Taobao. So taking all that in, where does this leave their actual trajectory going into the next quarter?
It leaves them essentially asking investors for a lot of blind patience. Toby Yu, their CFO, flat out warned that adjusted EBITDA is going to, well, continue to fluctuate violently in the near term because of intense competition.
Right, because they have to keep pouring money into those user experience subsidies.
Yes, they are planting these massive 5-year flags, $100 billion in cloud, $1 trillion RMB in quick commerce by 2028. But they are effectively telling Wall Street they need to run with startup levels of cash burn today just to get there.
Which is a pretty wild posture for a tech giant. You are asking the market to trust you for profitability all the way out in 2029, while in the very same call blaming current margin softness on, what was the quote? A warm winter and a late Chinese New Year.
The weather defense. It is always a classic. I mean, look, whenever management points to the thermometer, I immediately assume they are just aggressively couponing to keep their market share from bleeding out.
So then the real metric to watch next quarter is not just top-line revenue. It is whether dumping Ella.me for this new Taobao instant commerce brand actually builds sticky habits, or if they're just, temporarily renting loyalty.
Precisely. And there is one other wild card we should probably watch. They explicitly mentioned on the call that they do not rule out a future IPO for T-Head, their proprietary chip unit.
Oh, wow. Okay, so if the internal capital expenditure gets too hot, they still have some very valuable silverware they can spin off.
A silicon parachute, yeah. It just goes to show you that Alibaba is essentially a massive infrastructure play right now, just walking around in an e-commerce trench coat.
Infrastructure in a trench coat. That is the perfect framing for this quarter. We'll have to see if the market keeps buying the disguise next time around. It is always wild pulling these numbers apart. If you want these earnings drops to just show up, go ahead and follow the show. Just a quick heads up, we use AI tools to generate this podcast, mostly so we can digest massive filings in record time. Send your ticker requests over to earningsunscripted@datamadness.ca or grab the X link in the show notes. Thanks for hanging out today, and we will catch you on the next call.
See you next time.